Welcome everyone. I'm just going to open up the questions box here. So if you guys have any questions for me during today's presentation, just go ahead and post them in the Q&A box. And today we're going to be talking about maximizing gains using momentum-based Fibonacci. So this is a class I've given a few times over the course of the last year, and what you'll notice about all of my classes and presentations that I do is that I like to draw upon what I've seen happening in the past, trades that I've taken over the past several years, as well as what's happening right now in the market. So you're going to find a wide range of trades over a wide span of time so that you guys know that what I'm teaching you is something that really does withstand the test of time. It's not something that, works just now in today's market, that works, just trading Forex or futures. It really works on every time frame and in every market. So I focus primarily upon looking at and understanding pure price development and understanding pure price action. And all of the strategies that I use are built upon that. In today's class, what we're going to look at are, first of all, what momentum is, what it means in the security, and the important role that it plays in determining a security's fate. So this is going to be one of those tools that relies purely upon looking at the charts themselves, sans any indicator whatsoever. We're also going to be looking at how to correctly utilize Fibonacci extension levels to identify targets. So Fibonacci is one of the indicators that is based upon price action. So we are going to be looking at that as a way to provide additional confirmation to what you are already able to see with the momentum development in a security. We're also going to be looking at how to manage positions and adjust targets as a trade unfolds. So we're going to be tying the two together. We're going to be looking at momentum and Fibonacci extension levels and how those work together to identify target levels and manage trades as they unfold. To start with, we need to first have a good idea of what momentum is. So momentum is basically just the average pace at which a security is changing price over time compared to how it did it in the past. Now, when we're looking at what is average momentum, we're going to be looking at something on a security where you find those deep V's and back and forth action. It doesn't matter if you're trading bonds, stocks, futures, whatever. You're going to find places in the market where you see this back and forth type of action. So when you look at each side of those V's, this is what we could consider to be typical average momentum. And when we look at how momentum compares as a security is unfolding in time, we are comparing the current momentum to those periods of time where we had that back and forth type of action. So up here, for example, we have what would be considered a slower than average pullback or correction. When you're looking at momentum, slower than average is usually going to lead to the stronger moves. So breakouts from these slow corrective periods will usually be pretty strong as long as the trend is new and just getting underway. As a trend starts to exhaust itself, you'll usually see momentum begin to shift. So even though it might continue to make higher highs, such as here, you'll often see momentum shifting. And sometimes it will shift by creating a channel that shifts, meaning if we have an uptrend where we have a strong upside move, and then we still see higher highs, and overall, each of these highs is made with, pretty similar momentum compared to the past. What you'll notice is that overall, the trend channel is beginning to shift. So this is changing momentum, even when the smaller time frames look like the momentum might be the same. So we're looking at momentum in several ways. We're looking at how it changes in a larger impulse move, as well as how it changes on the smaller time frames. When momentum begins to slow, like it does here, then you're more likely to see some of those stronger reversals happen, where you can get things like a 2T, which is a type of double top, where you just have a slightly higher high. Creates a trap and can lead to these reversal patterns. When we look at momentum as it continues to unfold, you can see here how those shifts can really develop over time. They can create these rounded highs and rounded lows that you'll see in patterns like a cup with handle, an inverse cup with handle. And even though the upside in most of these is still pretty comparable to what we would see with an average V type of move, the channels themselves are shifting momentum. When we're looking at how to read momentum, therefore, I'm looking at the momentum within a channel. So you can transect a trend by looking at highs and lows, putting those together, connecting one high to the next high and so forth, and one low to the next low, and basically splitting right through the middle of most of that price action. And that's going to show you, how momentum is changing over time. Here's one example. We have a lot of impulse moves back and forth on smaller and larger time frames. And overall, we have moves that are pretty strong on the upside, even though the momentum within the channels is now starting to shift. So we had initially some pretty strong upside channels, slower downside channel, which allowed, for another nice continuation on the upside. And then we had this inverse V start, this mountaintop basically. Had another little V at lows, and then went to a slightly higher high. So this created a new trading channel here, where when you transect that channel, that gives you the momentum of that overall channel. So even though the smaller momentum moves still look like they're strong on the upside, we are actually seeing momentum begin to shift. It shifts further over here, where even with strong upside and downside moves, the channel itself is now going sideways with this widening triangle. So momentum, when you first think of it, might seem like something that's really simple, but if you're not looking at the overall channel that you're trading, then you can miss some of these shifts in momentum that can indicate that a trend is reversing or that it is nearing exhaustion and it needs to take a break. When we look at momentum expectations, we're going to see how these tie into Fibonacci here in a minute. But there's a couple of general rules to keep in mind when we're looking at strategies that are things like a continuation strategy, like your typical bull flag, your head and shoulders patterns, your cup with handles, general channel breakouts, all of these. Typical action on a breakout, such as any one of those strategies, will be that the breakout itself will want to try to mimic the momentum that it saw in the impulse move that took place before the period of correction. So there's a couple of terms here. We're looking at impulse move, which is a primary direction of a market move. So when you look at a chart and you see these waves of strength, those are impulse moves. And then you'll see slower moves where maybe there's like a lot of overlap from one bar to the next, a lot of congestion. You might not be able to make out, where this trend is going. That zone is called a correction, and they tend to follow these impulse moves. So this correction here has a momentum shift where we're looking at a slower pullback compared to the initial upside move. What's key about this correction here is that it holds within the upper 50% zone of impulse move A. That is important because it gives this a better chance to be able to break through the previous highs at A and go on to establish a higher high. If you had this more of a V and it pulled back to the lower end of this channel, it's going to run into trouble when it comes to that upper level again, and it's going to serve as a resistance zone. So with a pullback or correction that is about 50% or less, You can look within that correction for smaller changes in momentum like you see here. There's a pull up and it hugs that upper end of the trading channel. So this is a strong indication that that trading channel is going to be more likely to break to the upside than fail. And a lot of times it's that very last smaller momentum shift within channel that can give you an indication of which way that channel is going to break. So to start with, this had a pretty strong move to the downside. Well, if that had based at that lower level there instead, let me clear that so you can see that a little bit clearer right there, then that could have just as easily fallen and came back into the zone over here. So by pulling back up, gaining momentum, and then falling into a channel here, that momentum shift alone was enough to allow it to break and continue to the upside. Now, when something breaks to the upside out of a trading channel and the momentum is comparable to the impulse move prior to that trading channel, whether it's a bull flag, bear flag, sideways trading range, inverse cup with handle, or inverse head and shoulders, any of those things, as long as this momentum from B is similar to the momentum from A, then you're looking at a target level that's going to be 100% extension of the move that is similar to back here. So when we look at adding Fibonacci to these, we're going to be looking at these extensions where we're using these 3-point marks. Let me show you here on TradeStation one example. Here's Tesla. So here's our tool that we're going to be using, the Fibonacci price extension level over here on the left. Let me clear this for you. And what we are doing when we are adding these is we are going from the high to where momentum first falls into a period of correction, and then to the last high within the move before it breaks lower. This is key, guys. This is something that you might see done differently in other places, and frankly, they're wrong because it's not going to work as well if they're going from the absolute high to the absolute low when in fact momentum begins to shift back in here. So when we are looking at an impulse move in the market, and we're looking at adding Fibonacci extension levels to the impulse moves, what you need to look at is how does that impulse move develop and how does it look on the smaller time frame. So the main move here on Tesla took place from here to here, and then when it got to this low at this point, what you actually saw happening here is it began to correct over time, meaning the low of the impulse move was right here. Not here, it was here. And so when you're looking at drawing the Fibonacci extensions, you then go to the last high within the correction, and that's not necessarily going to be the high of the entire correction. It might have pulled up a higher here and done that. You go to the last high within the correction, because what we are looking at is we want this breakdown to be compared to the impulse move that goes into the correction itself. So this move, I'm going to flip back to my PowerPoint here, is one that we were looking at in my market timing bootcamp, where we were looking at a continuation trade of this little avalanche coming out of its head and shoulders. Here's your shoulder, here's your head, here's your shoulder. So this this right shoulder over here is the avalanche as well. And we were looking at, okay, where are target levels going to be placed on this thing? You know, what's the next levels of support that we need to be looking for on this large daily time frame? So we talked about a number of different types of support and resistance. One of them, of course, was previous periods of congestion, previous lows, gap closure, and then of course the Fibonacci extension levels. And because momentum on this was falling very similarly to what we had in the impulse move coming off of the high of that head, it meant that that 100% target level was going to serve as the next major daily support. So let's go back and look at how that looks on the chart. So here is that daily time frame, and I just opened it up a little bit more for you. And notice that when we used the Fibonacci extension levels, according to how I added them here, we had that bounce almost perfectly off of that 100% level. If we had gone and used this low here, you wouldn't have seen that happen. It might have been the 76.4 zone or something like that. But when you compare what this impulse move here looks like and the momentum of that impulse move, that's really what we're comparing when we're looking at that breakout and continuation here. So going back to the chart itself, you can see that since then, this has fallen apart even more, but it held that level really well for a good 4 days. And then it broke down to that 138.2 level. So we are now at the next level of Fibonacci extension, and momentum here has been increasing on this. So we're still looking at this as being a play where weakness is, the general guide here, but on the smaller time frames, we might be able to get things to start to turn around here over the next week or so. Do I look at fundamentals too, or do I only look at technicals? So asks Market Maker. That's an interesting name you have there, Market Maker. So actually, I look at both if I'm looking at long term. So if I'm doing like position trades, longer term investments, then the fundamentals will matter. But for the shorter time frames, they don't really matter at all. And yeah, some people are going to argue with me on that, but frankly, it doesn't, because a lot of times the technicals are going to tell you something before the fundamentals might shift. So, and alternately, something might look great fundamentally, but when you go and pull up the chart of it, it looks horrible. And you can't even see any decent reason for it to turn around. So, so no, I don't look at all at the fundamentals for the short time frames at all. So alternately, let's look at how momentum shifts. When we have momentum actually increasing coming out of a trading channel, like we can see here, nice little two-wave correction, momentum is picking up, immediately picking up. Well, in those cases, you're going to get larger than these measured moves, greater than equal moves. So this is where we can use those Fibonacci extension to look at things like the 23.6, 38.2. These are going to kind of push it further past what that 100% level is going to be. And a lot of traders have difficulty, identifying, okay, so if something goes past that 100% level, then how do I know which level it's going to stop at? Is it going to be able to stop at, especially if it's something where you're at all new highs and you don't have previous price resistance to fall back on? Well, that's where things like Fibonacci comes into play. So when we're doing the Fibonacci extensions, we're doing a first low here, at the low of the trend, high at the high of the trend, the impulse move. Here's our last low within that channel, and then the break higher. So as you can see, this kind of blew right through that 100% level, but it stopped exactly at that 123.6. What you'll notice is that when it hit the 100% level, though, a lot of times securities will start to stall at those levels. So when momentum is stronger than average, it's not that the Fibonacci levels completely fail. They can act as turning points. So they can stall a move or slow a move. So we have a rally that's strongly into that 100% extension, but it slows the move at that point. So it still continues, pulls into the 123.6, and then ends up holding that. Now, how they react to those levels and how to manage trades as they hit those levels. This is where you drop down to smaller time frames and you look for momentum shifting into these resistance levels. And that can give you strategies that will allow you a heads up that things are going to begin to turn at those points and give you a better chance of taking gains at those levels. Now, usually when I'm getting into a trade, I'll have a bracket order on the books. What that means is that when I place my order to enter a trade, it automatically enters a stop order and a target order. So when one gets filled, the other gets canceled. With a stop on a continuation breakout, I'll usually use under these lows. Now, I will point out that when I'm putting stops on the books, I put them much wider than I would generally prefer to take the actual stop. And this is because I don't want them just getting touched and wiped out, or people seeing them and hitting them, anything like that. You just don't want any reason that they're just going to get flushed out. But it gives you protection in case you do have to walk away. If you have an emergency, you can't be there as something is coming into the stop levels. Instead, what I do is I put an alarm up, so that as something is approaching or nearing a stop zone, I'm usually going to manual, and I'll manage it manually at that point. But it will keep these things on the books. So the same thing happens when something's going into a target level, especially something like the 100% target level measured move. I always have something on the books just shy of that exact level, so that I can get a fill as it's moving into that level instead of trying to fight with other traders as that level's hitting. Now, if the momentum is increasing though, then I might go ahead and drop it down to only closing half the position, or I might take it and move all of it up to where the next resistance level is going to be, like the 123.6 level, and put the order instead under that level. So this will allow me to get more out of the position, but at the same time, I'm protected just in case something happens, and I can't manage it manually myself very easily. Here's another example, ALGN. In this case, we had a breakaway gap, and it went right past that 100% level. But you can see where some of these other levels still served as resistance. It stalled at the 200 with the gap itself, and then it ended up shifting momentum and holding that 300% level. So it likes to move in these measured moves over and over again. Even when it's doing it in increments where it's doubling it, it's still keeping that symmetry. Now, on the third level, we have situations where the momentum is actually more gradual than it was going into a correction. So the correction itself will be followed by a slower breakout from that trading channel or that pullback. Even though this was still a 50% pullback, it struggled, and this is why that 50% mark is kind of like a key turning point in a trade. If something is holding that 50%, it can break through the previous highs a little bit better. If it holds the upper third, that is substantially better. When it gets to the 50%, then it becomes more iffy. It starts to switch. Is it going to hold those previous highs, or is it going to be able to break through those previous highs? Well, if momentum is shifting and we have a slower momentum move compared to the previous impulse move, then that previous high has a much, much stronger chance of holding. And it's going to lead to things like a double top or a 2T, where we can get these reversals and these breakdowns much, much more easier. Here's an example of that. This is from years and years ago, a trade that I had that was a two-wave continuation move. It had had a lot of action on news earlier in the day, and it broke out. Now, what you'll notice very quickly is that the breakout momentum just couldn't sustain the same pace as it had going into the trading channel. In fact, we began to see one of my favorite strategies develop, which is the momentum reversal. A typical target for a breakout is going to be that 100%. We're looking for a measured move. But when momentum starts to shift, you have to be proactive and address that momentum shift. So we look for Fibonacci levels within here that are going to serve as resistance levels. And if you've got 1, 2, 3 highs with shifting momentum, get out of there because that is going to fall fast. So let's look at that in some more recent action. So this one is from the class I gave earlier this year where we were looking at timing market pivots, and we were looking at Facebook. And this was another breakout that took place in Facebook. And you can see again, the momentum was more gradual coming out of the trading channel, but it still held these Fibonacci levels incredibly well. And actually the 76.4 is one that I find holds the most often when you're looking at things where the momentum is starting to slow or starting to shift. And so that's a really good level to kind of aim for, but also there's another thing to watch, and that's understanding trend development. So when you get breakouts, typically a breakout is going to have two waves of action on the upside before it hits resistance. So if you've only got one wave, you're probably going to get a second one. And sometimes it will do 2 and 2. So we have 2 and 2 here. Has 2 waves up, little 2 waves back, little 2 waves up, bam, right into that 76.4. So at this point, that's telling me, okay, this is where I want to be taking my gains on this thing, because at that point, trying to expect more out of it becomes much, much, much less likely. Again, we're combining not only the momentum with the Fibonacci, but also a greater understanding of trend development in making this decision. So if you want to learn more about trend development and the nuances of trend development, then stick around because I'm going to tell you a little bit about the bootcamp, the market timing bootcamp that I have going on, that you guys can still get in and learn a lot of these more nuanced details about reading pure price action. Now, if you were hesitant and you missed that opportunity, which was the point to get out of this trade, and you're still holding on thinking, okay, I still want that 100%. Well, here's your confirmation it's not going to get that 100%. It goes and it shifts momentum yet again. And at this point, it now has 3 highs, which if you'll remember from that previous chart years ago, is basically a dead end for that high. You're going to see the reversals start to happen, or at least a longer correction start to happen at that point. So that becomes a way that you can tighten up your trade, and you can say, okay, you know what, I'm not going to go for break even. I'm not going to go for like an altered stop. If this breaks, it's confirming a reversal strategy. So you really need to be out of that trade by that point. Another example here on Amazon, same type of thing, same shift in momentum, and we also have the same 3 highs developing. But let's bring this up even closer. Let's bring this up to a trade that I had last week. This was on the pound dollar, and I'm going to show you another one here this week too, where again, we had these moves to the upside. You can see in this case, the momentum slows just a little bit. Start to see more overlap from one bar to the next. It makes it to that 76.4%, but it's really struggling by that point. It continues and then offered this little 2-wave move to the 3rd high, 1, 2, 3. So I was actually able to use this resistance and this trend development to take a reversal at that point. So it triggered a short right in here. Actually, it was a little bit earlier is where I got into it. I did a screenshot for my boot camp to show you guys the exact price. But knowing all of those things, I actually got into it, this very high bar here, right before it even started moving at all. It hadn't even broken that channel. And the reason is that I understood the trends development and the dynamics that go into play with the momentum reversals and with the shifts in momentum. We had the same thing happening here again this morning in the same currency pair in the pound. I can show you guys that really fast here. If I grab the right writing tool. And I'm going to show you that on the 15-minute as well. So here was the strategy this morning. Same idea. Here's those two waves to the upside, and then here's that shift. So we had the 1, 2, 3 highs. Bam. That's where I was first looking at it, but I didn't like that the momentum still wasn't shifting. So I went with the avalanche instead. So these are all based upon strategies that are dealing with these momentum shifts. And then you are using things like the Fibonacci to identify where these levels of resistance are going to be. So these offer these great points for not only taking gains if you happen to be long a position, but also timing reversal strategies as well, such as the one from last week and then the one again today that was heading into today. So here we can see this a little bit closer from last week. Again, showing some of these Fibonacci extension levels and how resistance is holding at these highs. Oh, here's the screenshot from the trade. So you can see this is where I got in, took the screenshot as it was forming and developing there. And then here was how I followed through with that trade. So with that trade, it was coming off of those resistance levels that we just looked at. And the typical target level with a momentum reversal strategy is to look at that pullback from the first high, and that's going to give you support. Now, sometimes you can get substantially more than this, but it depends on how it follows through. So if this had followed through really quickly to begin with and only had like one wave of downside right into that support, then you would have room for a second move that would have brought you into this support here. So momentum is really, really important, guys. It's probably like the most important thing to pay attention to when you're looking at trades. And then I would say that time development and trend development are your next two most important things. Volume can play a role in here. You'll usually see overall volume will be the heaviest as it's going into the first high and then decline with each of these subsequent highs. So that can help you out, give you a little bit of an additional heads up. I know I'm going a little bit fast today, but we do have a shorter session and I want to get through everything, but you can always go back and review and study this class. And in fact, I want you to make sure that you do that because you're going to find a lot of hidden gems over time. What's interesting with Fibonacci and using Fibonacci extension levels, retracement levels as well, is that those levels will hold incredibly well over time. So for example, those first Fibonacci levels that we used to look at the initial rally here on the pound last week, you can see where it continued to have support and resistance levels going forward. And we saw that again actually today as well when we were looking at the price action today. So the extension on the pound here to this morning, going into this morning, was that it had that 100% level, which hit pretty quickly, but it was starting to gain some momentum at the end. It had about a two-wave move up, another two-wave move up here, hit that 100% level. That stalled it, but it wasn't enough to turn it quite yet. Instead, it came up to the 123.6. That was a point where, again, stalled the move and then shifted momentum into the 138.2. You'll notice again when I did my lows to highs, even though this did a higher high in the middle of the congestion, I used that first high because I'm looking at this impulse move compared to this impulse move. And then again, the support levels continued to hold. And when we look at how have some of these levels continued to hold throughout the day, you'll notice that a lot of them really do continue to serve as support. Even when we go back to last week and we look at, well, not last week, but a couple of days ago here, this is the 15-minute. Let me clear this. Even when you go back and look at previous moves and how those support and resistance levels hold over time, you're still going to see that they often lead to these stalls at these different support levels. Now, where you have levels overlapping, that means it is an added level of strength. So where you have these two Fibonacci levels that are basically hitting together, or you're coming into like these levels where there's a lot of them all at once, those are stronger zones of support or resistance. And you can look for things like, previous channel levels, previous lows, those are all going to help as well. And you can even look at when we look at a move that is on the run and it's already started, and you're looking for some added visual confirmation, you can go and look at that move as well. So here's the breakdown. Now the one that I took was a little bit earlier, so it was back in here, but here's another continuation with the avalanche heading into right around very early this morning. And you can see that it hit this 100% level, but momentum was stronger coming out of this. So it had this rapid 1-bar drop. And let me widen this up here so you guys can see this even better, actually. So it had this really strong initial drop here, which helped increase the momentum. And again, think in waves of 2. So we have the 2 waves down, pulled into the 138.2, and that can help you also. So if you've got like 2 waves that you can see and discern very clearly, if you only have 1 wave, look for a second wave. And you can do a measured move even, looking at that first wave and then comparing the second wave. So that can also give you an idea of where upcoming support levels are going to be. Michael asks, I have a 123.6 on projection, but I've seen 127 at investing.com. Please explain your level. So my level is based upon the key Fibonacci levels, your very core basic ones. 127 is a variation. I have an entire course that goes into Fibonacci. It's 8 weeks and many hours. So if you want more information on delving into Fibonacci itself, you can go to tonihansen.com and you'll see like probably the most comprehensive course that I've ever done is on Fibonacci. So it goes into and explains that 127 also. So it's just basically another level, just like some traders will gravitate towards a 40-period moving average, whereas others will use a 50-period moving average. Some will use the 127 versus the 123. Now let's go here and wrap on up. And I'm going to pull up the information here on the boot camp. So as I mentioned a couple of times, I have a boot camp that is a market timing boot camp where we go into all of the different building blocks of price development. So all of these things like momentum and time development and trend development and all these Fibonacci levels that you've heard me talk about today are covered in the boot camp. So it's a 6-week boot camp. And we've got 5 weeks available online already. You've got 14 hours of premium online training. And we have 1 week of live training coming up where it puts all of the lessons from all 5 weeks of all the previous 5 weeks into 1 week where we are going to be looking at trend management and trade management. So when you're getting into trades like these momentum reversals that I've showed you here today, the upcoming week is going to be focusing upon how to manage those trades and how to determine, okay, is this level going to hit this time, this Fibonacci level, or can I look for, further Fibonacci levels? And it integrates trend development along with the momentum, along with things like time development. And that means has like a strategy developed long enough to be valid to give me a great setup? Or does it need to, for example, base out and congest a little bit longer before it gives me a great trade? And time development is really a key that a lot of traders overlook. You're also going to get a copy of my market timing playbook, which is several hundred pages that goes over the pros and cons of all of my favorite trading strategies. So it will show you, for example, if X, Y, and Z are in its favor, it's going to be a great trade. If J, K, and L are happening, those are going to be cons against the trade. It gives you trade examples that show both pros and cons because let's face it, not every trade is textbook and you need to understand what cons are going to be more important. If something is against it, might it still work out? Or is that going to be like the kill shot and that's going to be it for the trade? You're also going to have a copy of my 5 technical signals you cannot trade without, which is probably the book that I have sold the most of. It's definitely been one of my most popular books, and it goes into my style of market analysis in great detail. And it is written from the perspective of somebody that is a newer trader going into intermediate trading. And you'll find a number of advanced things in there as well, but you'll definitely be able to pick it up and follow it very clearly if you are a newer trader. So you've got 14 hours of premium online training. We've got all of them in video that you can go back and study at any point, anytime. There's 2 hours of live training coming up next week. You'll get a copy of my market timing playbook, and you'll get a copy of the 5 technical signals you cannot trade without. And plus there's a bonus 6th signal. So when I first did my 5 technical signals you cannot trade without book, I did not include time development. And that is because that's something that took me longer to really develop as a building block. It was something I'd always noticed, but I always just built it into the trend development phase of things. And I figured now, you know what, it needs its own place because it is really something that even if your trend is working in your favor, if you don't understand the time development that goes into the trend, you're going to be in a lot of trouble. You're going to miscount your waves and just mismanage trade positions over and over again. So time development is one of the big things that we talk about during this boot camp. And I've devoted almost an entire day to discussing that. So one of the weeks that you will have access to will talk about time development as well. Again, to learn more and register for that bootcamp, you can go to tonihansen.com/bootcamp, and this is going to be the last week that you can get into this bootcamp. So if you are not already a part of it, go ahead and head over to tonihansen.com/bootcamp and join now. And if you have any questions for me throughout the course of the bootcamp, you can email me at info@tradingfrommainstreet.com. I'll post that in the chat box here as well. That's info@tradingfrommainstreet.com.